And we're good.
Hello, everyone, and welcome again to an expose live at 5 with myself and Ben Richards. We've got, I think, our busiest episode today with lots of nuggets, advice, findings, highs, lows, and woes. So we'll be running through the agenda shortly. But for those that haven't joined, we are, I would say, serial entrepreneurs, and we've opened up multiple businesses that we operate all connected together in an ecosystem that we operate. And the purpose of these recordings is to hopefully add value so that you can scale and grow your businesses as we have. For podcast listeners, it's the 17th of November. And let's get straight into the agenda. So we're going to be kicking off about the benefits of regearing commercial leases in property and why that might be able to create you free money. When you're looking to take on a new solicitor, what to potentially look for. We're going through the process of doing this, and we wanted to sort of share what we're looking for in a solicitor. Updates on our £10 million fundraise and how we're getting on with that and the communications that we've had externally. Finance brokers or directly to finance business companies. What is the best route, and should you use brokers is quite a key topic for people in the property industry. Lift potentially being approved at Muswell Hill. We'll be sharing the news on that. Central Suites today are paying back 4 of our investors, and we'll be sharing what project is paying them back and the reasons why we enjoy working with investors. The Young Architects and Developers Alliance event was hosted this week, so we'll be sharing about that. Local housing allowance. So in our social business, our rents are triggered by local housing allowance rate of rent. And we'll be sharing our readings on it and reviews. It potentially could be going up in the autumn budget, which would be huge for landlords that rely on LHA rents. We have a night with Lord Phillip Hammond. I think Ben will be sharing about that. I'm not even sure what he means by that, but we'll hear more later on today. I hope alcohol wasn't involved because that could have been slippy. I had an interview with Tom, a Prolific People podcast, and I'll be sharing what we talked about. A construction industry update. So we're going to be talking about supply, demand, cost of construction, what we're doing to protect ourselves doing projects, and keeping your investors updated on progress. Our award-winning brackets template, and we'll be sharing what that looks like. And then finally,
I put on the screen for those podcast listeners. If you go to bit.ly/xp_templates, you can request all of the templates that we use in our business and reach out for specific things that we would have discussed on previous episodes, and also some of the stuff that we talk about today. You know, we have templates that we formulated over the last 5 years that have helped us kind of be more efficient and do, you know, essentially one transaction every 4 weeks over the last 5 years. So we've been super busy, and we've always been able to do that because of the sort of templates that we've created. So they can be available to you. Head over to bit.ly/xp_templates to register your interest.
We'll also put it in the comment section after the show for virtual listeners. And then last but not least, your questions answered. So quite a long episode, but there's I think all the topics are super relative and interesting. So kicking off with regearing leases.
Yeah, I mean, this one's sort of mainly your bag, but I think, you know, it's become apparent this week, dipping into some of the stuff that you and Aaron have been doing with one of our latest acquisitions in South Oxfordshire. So this is the 17,000 square foot office that we're going to be converting. And, you know, a lot of the people that listen to this are probably wanting to get into commercial to residential conversions. It's been a very hot topic over the last 9 years, really, since permitted development rights came in. But it isn't always the best route to convert commercial to resi. You know, there's often an angle where you can bring in or re-gear leases to better suit your terms, or an increased length of term, which would give you a better covenant, or an increase in rental income. Again, a better covenant and a stronger covenant and more income. And that's what regearing leases is all about. And on this particular project, we've actually got heads of terms agreed now with a commercial occupier for 1/6 of the office space, which actually values up that piece of the building to about 50% of the value of what we bought it for, which when you do the maths on that, and the fact that we wouldn't have to actually spend a penny on, the fit out of that particular unit, that is massive. And that is just a paperwork exercise that effectively adds a significant amount of value to your asset. So that was all I really wanted to say. I know, Jack, you'll probably have more to speak about on that.
Yeah, so it's for me, I think it all boils down to when you're looking at sites, making sure that you've got your handle on your pound square foot values. And I think that the more you really understand that sort of higher level sort of ergonomic of property development, the easier it becomes. And what I mean by that is this building that's on screen. We bought the building for £140 per square foot. We're hoping to achieve residential values of 475 per square foot. You figuratively know then 140 in, granted that is the net cost, so the actual gross cost, including all the purchasing elements, stamp duty, legals, whatever it may be, will be marginally higher than that. But if you know you're getting in at 140 and you know you're selling at 470, there's huge margin there that needs to be lost or paid or built or converted for you to not make a profit. And what Ben's getting at is that development and conversion, because the site that was there is a flat conversion scheme. So we are getting in, ripping it apart, converting to flats, and we should be averaging about 150 all in for our build. And then there's an element of finance, and there's an element of sales. So you can sort of see the 140 goes to 300, including build, and then some other costs around that, professional fees. And that's where our profit margin is sat, just below that 475 mark. But if you can increase the value of the square footage without all the headache of having to go through building control, professionals, planning, design, delivery, sales risk and market is probably the biggest element, because we're very comfortable delivering stock. Sales is something that you can't necessarily always control, especially if the market is changing, which we are in a changing market. But we've, as Ben mentioned, have re-geared those leases to sort of high 200s a square foot without doing any work or any more benefit to that site, other than showing a case study that we think the building's worth more than what they're paying at the moment. Re-gearing their lease, we're actually relocating them as well to suit the development sort of delivery. And we're achieving sort of high 275 a square foot off the basis of buying at 140 a square foot. So we've made a profit just by re-gearing a lease. And sometimes you can look at risk reward, work reward, return on time, return on risk. But sometimes it's easier to segment a bit of the site, de-risk it. We haven't got to sell as many flats. If we didn't re-gear that lease, we'd probably be selling over 35 units. Now that we have, it will probably be something like 25. I don't know the exact numbers, but that is an element of resales that we now don't have to deal with, and we can be a lot more on point with a smaller amount of stock going to market.
Awesome. It's probably also worth mentioning that the rent roll that we're getting in from that asset is also paying for 60% of the debt that we've got on the site. So we're also servicing the debt of the development finance, which is massive. Thanks, David, for your comment. I will try and sort out the link so that anyone can access it. Something's gone wrong there with Google Drive, but I'll sort that out as we talk. I think hopefully that's been a really sort of interesting eye opener of how kind of re-gearing leases can help you in your business, and don't necessarily have to convert to residential all the time.
Yeah, I think we've referred to it before, Ben, where it's like ego development. You don't have to be building high rising blocks of flats and getting into the ground and having double-story basements with loads of groundwork infrastructure. Sometimes if you can trade on a deal, trade on a lease, turn some paperwork around, you can be a lot more stress-free and a lot more profitable and a much better return on time.
Yeah, nice.
Good. Taking on a new solicitor. So this is for listeners out there that are maybe not happy with their solicitor, and I feel that's 99% of people, because everyone wants everything done immediately. Solicitors' nature of work is to be detailed and to not rush things and to not make mistakes and to protect their clients. There are good ones, there are bad ones, and we've certainly seen all of the above. And more importantly, there's expensive ones and there's cheap ones. And not necessarily you always get what you pay for, because I feel like solicitors, you sometimes pay a lot for not a lot. But we are currently doing the rounds to look for a new solicitor. Our existing soliciting firm we've been using ever since we've set up the business have lost a significant amount of staff to other businesses, and we don't think they can facilitate, our growth and support our business in the way that we need to grow. So I just wanted to sort of share what sort of key indicators that we're looking for. And some of them are logistical, some of them are, probably more technical and legal. And we've also actually, Ben and I have discussed about potentially bringing someone legal in-house, because we do spend equal to a salary for someone fairly senior a year on soliciting. But the reason we haven't opted for that is because you can't sort of turn that tap on more or less depending on your pipeline, your delivery. You've probably seen we've been quite active buying sites second half of this year. We might not buy many sites the first half of next year, and that lawyer will probably be sat there not as busy, and then that as a cost to a business won't be able to be offset. Other things that we're potentially looking at relative to that is some financial lenders, some investors want to see a certain number of partners within a law firm to be represented. So specifically West One Loans, they would like to see 2 senior partners sat on a soliciting firm before you can use them. We've actually had it before where we put forward a firm to do a transaction, and that was rejected because there was only one partner at that firm, i.e. they weren't big enough. And you can kind of understand why lenders would do that, because it sort of ensures that someone can jump on something and the transaction will happen quickly, even if there's people on holiday. So that's another reason that we keep it as an external resource or an external professional outfit. Other things that we're looking at is locality. Ben and I have to sign a lot of documents. We have to get a lot of documents, witnesses. I've driven to the solicitors, signed something, driven back, and they've missed out one document. So we are considering the location of the firm that we're working with. Is it convenient for Ben and I? Because if it's in Northumbria, that is the most random location I've ever picked out. But if it is in Northumbria, it's going to take Ben and I a day to get there to sign and everything on signature days. And as much as we like it or not, everyone isn't transitioning to DocuSign. We always push for that, but it doesn't always go the way. And sometimes you cannot get into a position where you need to sign things and get it in the post a week ahead of completion, because a document arrives up, completion date's fast approaching, and you need to react and get that moving. So that's another thing to consider. Another point to consider is cost. So we were using an outer city firm. We also use a city firm for our social company, and the price difference is astronomical. It's literally like 4 to 6 fold, I would have said, in most cases for whatever we're doing. And the outer city firm is sufficient at delivering the work that we need in the capacity for XP Property. It's very, very rare, unless it's property sales, that we actually want the process of legals to go super, super quickly, because at the end of the day, it's building our pipeline. And if something falls this week or next week to acquire it, it doesn't make a huge impact. But for your sales, you might want to make sure that you have a very proficient firm, and you might want to split that out depending on the outfit. I think that's fairly it. I've got one more. Nice. I've got one more. Cool. Sets of rules and protection. So your solicitor should be protecting you, and we have a line of items that we need as a company integrated into all of our documents. So we have sort of a set criteria for acquisitions and contracts, set criteria for investors, JVing, whatever it may be. And when we're working with solicitor, when we meet with them, we want to ensure that they're happy to integrate this into their documents, rather than pushing back at, and saying, I want to use these templates, I know best, because sometimes they don't. So working with you to protect your position is definitely a key one.
Nice, good. Andrew, thanks for the comments. We're having a few issues with the template link. I have changed the access rights, but it seems to be still playing up. It's maybe the bit.ly link that now needs sort of updating, but we've got someone on it in the background, and we'll get that link across all platforms ASAP. Cool. On to point number 3, which is all about our £10 million fundraise. And if you've not sort of caught up on this, there's an episode, I can't remember what it was, maybe 30, where we talk about what we're trying to do in depth. But effectively, to date, we've gone to a lot of different investment partners to raise the £14 million worth of equity that we have raised. And that's been quite difficult, quite painful, quite slow. So what we're now trying to do is bring some money into our business at group level and on a sort of more long-term strategic partnership. And I wanted to just give an update because we've had, I don't know, probably 10 plus, 15 plus conversations with family offices, with funds about kind of what we're trying to do. And it's been really interesting to hear that feedback, and very useful for anyone looking to do something similar. To give a brief overview, the sort of pool of funds that we're looking to raise is £10 million. And the idea was that in our heads, or the idea that we planned on sort of going forward with, was, okay, right, we've got a good solid base of social housing portfolio income, which could provide a stable, low risk, securitized type line of funding. We've also got our high return, high risk developments that we've been doing, where we've averaged around about 52% IRR so far over the last 5 years. And then we've got our pool of sort of HMO, co-living, shared living portfolio, which we're currently trying to increase as well. So, those kick out somewhere between 8 and 15% a year, depending on which ones you look at. Now, we thought sort of pooling all of those things together gave the solid base with the social housing, and then the return on that fund would be ramped up significantly by the higher risk. Now, what we've learned over the past couple of months having these conversations is that actually it's quite complicated for people to get their heads around, and actually the types of investors that we maybe are approaching either want one or the other, and actually combining the two just muddles things together. So we've had a lot of people suggest that we package up the social income, package up the development and sort of higher risk products as separate packages, and use them depending on what the individual fund or family office are looking for. A lot of family offices, from my understanding, are actually quite interested in that secure income, a 7% return. What they tend to look for is kind of doubling their money after 10 years. And that's kind of seems to be a key kind of thing that rolls through all of the conversations that we've had. And that 7% return compounded kind of gives them that 100% return over the 10-year period. So yeah, just some interesting feedback from the conversations we've had to date for those that are looking to go out and raise a larger chunk. And I guess it's worth saying, if you're one of these people that run a family office or a fund and would be interested in sort of having a chat with us about how we can partner up and create a strategic partnership, do get in touch. We'd love to have a chat with you. Cool.
Finance brokers. Good. So Ben and I have we met a American-backed firm that we did a lot of deals. I think we did over 15 deals within 3 years. Their rates went up, got less competitive. We loved working with them. Their process, their operations, their underwriting, their point of contact. We loved everything about it. But they moved out of the market because their cost of capital has significantly increased and made them not competitive. So we are going back to brokers. It was actually quite funny. I was speaking to Aaron yesterday. He said, should I go to anywhere else for this new deal on a refinance? And I actually realized that we've recently worked with 4 different brokers on 4 different transactions. Now, you're probably asking yourself, why would we do that? You're sort of getting full breadth of the market. There's boutique lenders that each broker have probably worked with and others haven't. And then there's similar market lenders who seem to be the most competitive at most given times, like your Shawbrook, Hampshire Trust Banks, Avamores. They seem to always crop up no matter which broker you go to. But there's certain brokers that have better relationships with smaller lenders and also with big lenders. So for listeners out there that use brokers or don't use brokers, this is sort of our 2 pence or my 2 pence on why or why not you might want to use a broker. If you're new and you don't know the lending market and you don't network that much and you haven't got that many existing relationships, I would highly recommend using a broker, because they do go to market, they do know what they're doing. And when we look for a broker, we look for 2 things. We look for sort of the technical experience. If do they know about net day ones, drawdown facilities, rolled up service? Do they know about potential hurdles that you will face within the process? Are they experienced? Have they got a track record? And then point number 2, can you communicate with them, and are they organized? Because I feel like if the broker is difficult to get hold of, that deal is so likely to fall out of bed. That broker needs to be on everyone's cases. I know one in particular, if he says, I will call you at 7:45, he will call me at 7:44, and he will never fail to follow up on what he said. So organising communication is really, really key. once you started working with brokers and people in the market, there's no reason why you can't use that lender again and potentially save on the fee. But one thing I would say is don't go direct to that financial lender if they are not prepared to change the arrangement fee or the rate, because then you're putting more admin on yourself, removing one sales personality out of that process that can negotiate for you at no benefit. We've recurred a lot of loans with one particular smaller financial lender, and I actually emailed the CEO about 4 weeks ago saying, why are we still paying 2% arrangement when there isn't a broker in here? If that doesn't change, I'll just bring a broker in because it's less admin for me, no cost change for me, and we actually came to an agreement of a lower rate. So make sure that if you do go direct to a financial lender, there is benefit, because there is more negotiations that you need to do. There's more thought that needs to go into it. There's more analysis on their product and what they've given you. And there's definitely also more admin. That's a really key one that is pushed onto you. So I would just advise that if you do end up going direct, make sure there's a financial and admin benefit to doing that.
Nice. Good. On to point number 5. So I'll keep this brief. Yes, we actually did have the Section 73 planning application approved today to vary the internal layout, to add various other amendments to the external windows and external light wells to the front, to also include a lift within the scheme. Why is this sort of quite important for us? The main reason being that the lender that we have on the bridging finance or the development finance on this product held back some sort of net day one drawdown until we had the lift agreed at planning. So they agreed to release X amount of funds day one on completion, but they said until you've got that planning approval through for the lift, we are going to hold back some of those funds. So it's a big day for us. It means from a cash flow perspective, that's in the business. The planning application is banked, and we can move on. I was actually there today with our site manager walking around. We've got an arboricultural tree surgeon coming around next week to have a look at chopping down some of the trees to the rear. It gave me a few ideas about how we can maybe add a bit more value here and there with the layouts and the interior design. So keep an eye on that. We are going to be stripping out before Christmas, and we hope to start works on that in the new year. So really excited about that.
I would also say that if you're interested in hearing more about that scheme, do comment Muswell Hill. We will be doing a deep dive on that project, and we will also be doing a site visit once we kick off the works as well. It'll be nice. It'll be our first London site, Ben. I was thinking that it'll be very convenient for the London transporters.
That's it. Yeah, I mean it's a great location, Muswell Hill, North London. Actually, it's not a great location for transport because there's no local sort of tube. That's one of the benefits of it. A lot of people like living there because it's very leafy. You've got Alexandra Palace just down the road, and it's actually a little bit of a village inside of London that's a little bit out of the way from the hustle and bustle because it doesn't have a tube station and transport links like that. But very
I think
very
it's
high
got
value
a bus. I think it's got a
you
bus.
can still get a
route.
bus. You can still hop on a bus.
There we go. One response already. James wants to come along.
Cheers, James.
Cool. Point number 6, which is exciting news this week. We've sold one of our projects. We've completed today. Money popped up on my phone the other day, which is always a nice feeling. And we have completed on this property, which is a flip in Central Suites. And the most satisfying thing about it, equally for ourselves making a profit and turning a scheme around, is paying our investors back. So I've got 3 more payments that I need to make today, or I've already made one. But yeah, I don't know if you've heard of the phrase, the most enjoyable things about buying a boat and selling a boat. The most enjoyable things for us about working with investors is paying them back. So it's a happy day in the Central Suites clan with 4 investors being redeemed with profits. We're just finalising the final details of accounting, but we estimate that we'll be anywhere between sort of 25 to 30% IRR. So a strong scheme within a year. Sorry, I've got a dog barking. A strong scheme to turn around within a year, and this was a really straightforward, no planning risk gig. It was a very dilapidated house, and we just did a top to toe refurbishment and sold it for 600k. We bought for 310. and the build was about 150. So quite a nice, tidy little scheme.
Lovely stuff. Cool. This week, I was also on a speed mentoring event with the Young Architects and Developers Alliance. If you are a young architect, if you're an aspiring developer, please check them out. It's such a good group of aspiring individuals that are in the architecture and property space. It was great to speak to 3 or 4 people, mentees, I guess, for sort of 10 minutes, fast and sort of quick fire mentor session. But great to hear so much aspiration from architects wanting to move towards the developer space. Hopefully I gave some nuggets of wisdom and risk warnings, like I always do. Every single architect I speak to seems to want to be a developer, and I don't think they quite understand the full life cycle of how it works and the risks associated. But yeah, it's a great community of people. Last event I went to before this one was 400 people strong in central London. An insane sort of event of being able to pull that many people together, all in the same space, wanting to further their careers and also further their professional life within the sort of development space. XP Survey sponsored the food and drink at the event, so we got a little bit of exposure there, and I probably put about 300 XP Surveys pens out on the table, and I think I've come back with about 50. So hopefully a little bit of work comes through that route. I mean, it's our ideal client within that room, so fingers crossed something comes off the back of it. But yeah, thoroughly enjoyable day.
Very cool. Good. Local Housing Allowance review. So we've been building our social portfolio for 3 years now, and for the first time in I think history, there's been a 3-year freeze on local housing allowance, which came around due to COVID, and basically they haven't revisited it since that date. So we've been eagerly awaiting for a potential review of the local housing allowance. For everyone's understanding, it's the government set figures of what a borough gets paid via universal credit for someone that's on local benefit. And it hasn't got up for 3 years, and we were hoping that it would have come sooner. And we were sort of earmarking 2024 April review. But there's talks in the news that it could be potentially brought out in the autumn budget. Obviously, this is completely speculative, and it's being talked about, and they've had to review it in this autumn budget. And we're really super hoping that it comes this soon and not waiting to April, because it will benefit everyone that has that stock that is linked to local housing allowance. And to really put in perspective of what that would mean for us, is we are a social housing operator that charge affordable rent to the tenants, which is a registered housing association. So we are in line with what is, in inverted commas, affordable rent, which is below 85% of market rent. Everyone knows that market rent has significantly increased in the last 3 years, even during the COVID periods. So our private rental stock has gone up significantly. I was actually talking to a landlord that is based in southwest London, and he was saying his rent last quarter went up 25% in a quarter. And we're sat on local housing allowance that hasn't gone up for 3 years. And if it does probably go up, it'll probably go up something like 7%. We could really do with a 25% increase in a quarter. But what we're hoping to expect is that it does increase, and it does follow inflation, CPI, and also evidently market rents, because our affordable rent is now significantly discounted on market rent. And what does that mean, and why should the government increase it? Is because it is not attractive for private landlords to let their properties to social housing. So the gap between homelessness, vulnerable people, pastoral care people requirement, the gap gets bigger because it's not an attractive income for private landlords. So it needs to come up because it helps everyone in society, and we're super double fingers crossed. So we'll keep you posted on this. If it should go up, I'd be keen to hear if anyone's heard any more news about what they're discussing, how much. I think we're estimating it to be approximately 10%. We've actually got a forecast, well, it's not a forecast, I suppose, a historic table of the LHA rents for the last 10 years. If anyone would like to see that, comment LHA and we can send that to you. But make sure you put some contact details in there so we can find you and get that over to you. But we've predicted a trend of about 3.5% if you look back at the last 10 years and cast that forward. So we're hoping that if it's been frozen for 3 years, a 10% increase is about right. But we will see. And sorry, the point I was going to get on is the reason that that's so impactful for our social business is worth the rent times a yield. That's obviously a commercial valuation. So if the rent goes up 10%, our portfolio value goes up 10%. So it's not just the cash flow gets better, it's also the value gets better. So anyone out there that's got commercial valuation stock based on local housing allowance, your stock will be worth more when local housing allowance goes up. Obviously subject to tenant type, lease, tenure, full repairing and all that nonsense. But from a value perspective, it should look more pretty.
Nice, good. So a night with Lord Phillip Hammond. There were lots of other people in the room. It wasn't just me, and nothing seedy happened. So basically, what I wanted to touch on here is this was Thursday night, and we were invited by our capital allowance specialist, RCK, who, if you watched last week, I think we talked about them saving us £50,000 in tax on our St Andrew's Court office development. So check that out and get in touch if you want an intro to them. And was also run by Oak North Bank because Phillip Hammond is on the chair, on the board on both of those businesses. So it's a joint event. And what I really wanted to touch on is over the last 5 years, I've been to a lot of property networking events, and you guys listening to this have probably done the same. You know, your Progressive Properties, you know, Brendan Quinn's event, which we love, Canary Connections, like all of these great property events. But what I would say is that when you're going to these events as a business, all we really need to keep our business going is external funding, you know, more investment partners, you know, more cash to deliver the schemes that we're doing. And when you go to something like Property Investor Network or Progressive Property, you're going into a room of kind of want to be property investors, property developers. You're not going into a room of money. Now, these types of events that was held by you know, RCK, a capital allowance, and a tax compliance specialist, the room was full of accountants. It was full of brokers, financiers, high net worth individuals. There was a lot of money around the room, and I had probably 10 of the best conversations about investment with potential links to funds and family offices than I've probably had in the last 5 years in that one night, because I've kind of realized that we've been in the wrong room. These are the types of rooms that we need to be in if we need funding for our developments. And I've got a lot of follow-up meetings to do over the next couple of weeks, but I'm really hopeful that you know, something good comes of things. So if you're looking for funding in your development, going to property events probably aren't the right place for you. Go to business events, find some tax compliance and accountants events, maybe boring chat, but there's plenty of money in the room for you to tap into. Oh, you're on mute, I think, Jack.
Sorry, I'm in for all the listeners there now, I'm 8 hours behind in America and got a noisy household with dogs and all sorts in there. We're actually doing a fake Thanksgiving dinner today. So anyway, back to the podcast and the video. So I was fortunate enough, recommended by Ben, to record a interview with Tom Bolan. He's a property person, but I kind of feel that the sort of angle of the interview was not necessarily just property orientated, it was also business orientated, which I thoroughly enjoyed. And I think that business is not talked about enough in our industry, and that's why Ben and I do these lives. But without going into too much detail, I'll send you over there to go and watch the interview with myself, and Ben also did one too. So sort of highlights and snippets from the interview is talking about growing a team, managing a team. We even discussed how weird is it if my sort of median age is similar to the median age of our company, and how do you lead people like that? And I think that you lead together and you sort of work alongside everyone. That's definitely been mine and Ben's ethos in growing companies. But go over there, watch it. He's a really good guy and certainly got some interesting topics thrown into an interview. I think it's quite unique in this day and age when there's so many podcasts and interviews around to get something different that hasn't been said before or done before. So I think Tom did a really good job of that.
Nice. Just a quick update that I've been having lots of conversation this week with my Aura team and the wider XP team as well about construction tenders. We're going into a period now over the next 18 months where we're going to be building out potentially circa 75 units. So getting a handle on where the market is for contractors is quite key. Over the last probably 2 months, we've had 3 or 4 contractors email info@aurahomes.co.uk to say, we want to be on your tender lists. Here, mute yourself actually, Jack.
Yep, sorry.
Yeah, to email to say we want some work, basically. And 2 years ago, even 18 months ago, that just was not the case. What was happening then was we had contractors adding probably 30-40% onto their price, throwing it out there. If it stuck, brilliant. If it didn't, it didn't matter because contractors were busy. What we're seeing at the moment is that contractors are scratching around to a certain degree, which is great for you as a property investor, property developer, great for my Aura clients that are looking to undertake works very soon, because it means that they're going to come in more competitive, and you hopefully will see build costs starting to drop in real terms. So you can read BCIS and see what the RICS high level figures are sort of saying, but when it comes to kind of small to medium sized builders, which are who we typically work with, there will be hungrier companies out there looking for work that just want to keep their guys busy, and that should be good news for you if you're going into a construction phase within your development. Cool. So number 12. Now, we've introduced this over the last year or so because we've been delivering in a number of schemes, and we've been working with a number of investment partners, and we've created this, which is our investor monthly report, and it covers all things from the planning updates that we go through, status of kind of the program, the costs, the sales processes, anything from a construction perspective, relevant risks that are maybe causing potential delays, progress report of what's happened in this period and what's expected to happen next month, key milestones and dates, financial reporting, i.e. budget versus actuals, and then any other things that are involved in the project. So if there's updates on building control, maybe a general kind of market update of what the sentiment is, any sales updates in terms of how sales are going, or we're at the start of this particular project, so we're going to be creating a micro website for sales. We're going to be creating marketing brochures, and then there's some conversations around the commercial tenancies, which we spoke about earlier. So this has been really well received by our investment partners. It gives them a real high level snapshot of what's going on within the project, and it's something that they can come back and say, oh, can you give me more information on this, can you give me more information on that, and just helps to maintain that dialogue, maintain the kind of trust and transparency with the project. And a lot of investors that we work with don't want to know the ins and outs of day to day. They just really want to know, are you doing what you said you were going to do? Is it on time? Is it on budget? What are the risks that I need to be aware of? And that's what this report is all about. And we touched upon it at the start, and I'll say it again. To get a template like this from us, you can go to bit.ly/XP_templates, and we can share, and you could register your interest to get access to these templates amongst many others that have helped us kind of do what we've done over the last 5 years.
Just before we close that slide out, Ben, I think it's really key for any borrower like us, any developer, any investment partner. Ask them what they would like to see. It's super impressive when they get a document that's very comprehensive and very detailed, but they might not need that or want that or even need to see it. We've actually had some investors just go, tap me on the shoulder when my money's ready to come back. That's all I want to know. Out of the 4 investors that we're returning the investments from Central Estate, 2 of them are of that nature. They don't really care or know or want to hear from us which is quite comical. It's just some people are like that. So definitely understand what your investor wants. They may want more than what we've presented there. They might want to visit site and see that, ask that question before you build your own sort of process for that particular investment.
Yeah, very good. I mean, we've actually added a number of things based on the investment partner for that particular project's requirements. You know, they actually want to know a little bit more about the market sentiment, and you know, it's a large number of units that we're looking to take to the sales market next year. So having a good handle on kind of where the local market is was quite important to him. So we've added a segment on that. Finally, what are you struggling with in your business? You know, we will absolutely kind of have 10 things to talk about every week because there's so much going on across the businesses. But you know, we want to be talking about things that will help you and that will grow your business, and feedback on things that maybe we've learned in the last 5 or 6 years that can help you, you know, move to the next level. So do comment below, you know, not just during this live, but you know, afterwards, if you've watched this, if you've enjoyed it, you know, let us know in the comments. And if you've got any questions, we will get to them next week. Anything else you wanted to say, Jack?
No, nothing from me. I feel like it's been a very jam-packed session, and I think that just shows testament that a lot happens in a week in the various businesses that we have and are operating. But we've yeah, hopefully we'll have a equally as jam-packed episode next week. But we do want to hear, you know, what the people say. And as Ben mentioned, with these templates and questions, they're completely free. So if you want mine and Ben's brain on something for a few minutes, fire it in. We like to be challenged, so put some problems our way, and we'll see if we can either try and fix them figuratively or know someone that will be able to fix them.
Perfect. Nice one. So yeah, thanks for tuning in, everyone, and see you again next Friday at 5 p.m.